Gold hit $5,000 this year. Some reports put the peak closer to $5,400. Central banks are buying at a record pace. The US dollar is weak. There's an active military conflict in the Middle East. Every condition that is supposed to push gold higher is present right now, in real time. And gold is down 3% this week. It's sitting around $4,400 an ounce and still trending lower. Not because the world got safer, not because inflation disappeared, not because central banks changed their minds about accumulating it. None of that changed. So what is actually happening here? Because if you look at the headlines and then look at the chart, they don't match. And that gap between the story everyone is telling about gold and the price that gold is actually printing is exactly what this video is about. Before we get into why gold is falling, it's worth being clear about something. The bullish case for gold is not wrong. It's incomplete. The structural foundation is real. Central banks are on pace to buy roughly 850 tons of gold in 2026, still a record pace by historical standards. These aren't speculative trades. These are sovereign wealth decisions by countries that are quietly, deliberately reducing their exposure to the US dollar as a reserve asset. That process is called de-dollarization. And it doesn't make headlines every day, but it has been compounding for years. More countries, more gold, fewer dollars. Add to that a dollar index sitting near 99.85 on the soft end of its recent range, and a geopolitical environment that by any reasonable measure should be generating fear-driven demand for hard assets. The bull case didn't come from nowhere. It drove gold from multi-year averages to all-time highs above $5,000. That move was real, and the forces behind it haven't evaporated. Here's the question worth sitting with. Did you assume those forces would keep pushing gold higher indefinitely, regardless of what else was happening in the macro environment? Because that assumption, that the structural tailwind would override everything, is exactly where most retail analysis breaks down. The tailwind is real, but it doesn't blow in a straight line. The single most important variable for gold pricing right now is not the war. It's not central bank demand. It's real yields. And if you're not tracking them, you're missing the engine driving this correction. Here's what that means in plain terms. The 10-year U.S. Treasury yield is sitting around 4.42%. Now subtract inflation. Core PCE, the Federal Reserve's preferred inflation gauge, is running at about 3.1%. February PPI came in at plus 0.7% month over month, which is 3.4% annualized. When you do the math, real yields, the return on government bonds after accounting for inflation, are hovering around 2.05%. That number matters enormously. Gold pays nothing. It produces no income, no coupon, no yield. It just sits there. When real yields are negative or near zero, gold has a structural advantage. You give up almost nothing to hold it, and you gain protection against currency debasement. But when real yields are above 2%, that calculation flips. Government bonds are suddenly paying a meaningful real return. Investors who are allocating between assets do the math, and some of them decide the yield is worth more than the hedge. Then the March 18th FOMC meeting happened. The Fed held rates steady in the 3.5 to 3.75% range. They signaled one rate cut for the rest of 2026. Powell's tone was explicitly hawkish, citing war-driven inflation risks as a reason to stay cautious. The higher for longer thesis didn't just survive the meeting, it got extended. That's the mechanism behind the sell-off, not panic. Not a fundamental change in gold's long-term story, just the yield math tilting against it, and a Fed that confirmed it isn't going to change that math anytime soon. This is the part that confuses most people. There's a military conflict. Gold is supposed to be a safe haven asset. So why is gold falling? The short answer? Because this particular conflict is behaving more like a supply shock than a fear event. And supply shocks that feed inflation are structurally negative for gold in the current environment. Here's how it played out. When the US-Iran situation escalated, gold did get a bid. Safe haven demand came in. The price moved. That part of the textbook worked. But then oil prices spiked. Energy costs started feeding through into broader inflation expectations. And suddenly, the geopolitical story became an inflation story, which meant the Fed had even more reason to stay hawkish, which meant real yields stayed elevated, and the safe haven premium that gold initially captured got overwhelmed, not by calm returning, but by the inflation consequences of the conflict itself. Think about that for a second. The war didn't go away. The fear didn't go away. But the transmission mechanism from war to gold prices got interrupted by the inflationary effects of the war itself. The crisis created the very macro conditions that work against gold. Let me ask you something directly. If someone had told you 6 months ago that a major military conflict in the Middle East would break out, would you have predicted that gold would sell off on the news? Most people would have said no. That gap between intuition and outcome is the entire lesson of this chapter. Everything we've covered so far is fundamental. It explains why gold is under pressure. But the chart is where that pressure becomes visible, and right now, it's telling a very specific story. Gold is trading inside a descending channel on the short-term timeframes, the 15 and 30-minute charts. Support has formed in the $4,365 to $4,380 zone. Resistance is clustering at $4,450 to $4,470. Every time price bounces toward that ceiling, the volume-weighted average price, VWAP, is sitting right there, acting as dynamic resistance. Rallies reach it and fade. The heaviest volume concentration sits between $4,300 and $4,500. Which tells you that's where the most trading activity has occurred recently. Not a vacuum, not thin air, but a dense zone that price keeps returning to. Order flow confirms the picture. Sellers are showing up consistently on bounces. Buyers are only stepping in at lower prices, not aggressively defending any particular level. There's no sign of institutional accumulation, no sustained bids that would signal someone is building a large position into the weakness. This is corrective behavior. A sell-the-bounce market. What would change that? A decisive close above the descending channel ceiling with volume that backs it up. Not a wick, not an intraday spike, a clean close. Without that, the next logical test is the $4,200 to $4,300 zone. That's not a prediction. That's where the structure points if support breaks. Here's where a lot of investors get into trouble. They hear the structural bull case. Record central bank buying, de-dollarization, long-term floor under the market, and they use it to justify a near-term trade. Or they see the short-term technical breakdown and conclude that gold's long-term story is broken. Both of those moves are errors. The structural case is intact. 850 tons of annual central bank purchases doesn't evaporate because the Fed is hawkish for another 6 months. De-dollarization is a slow process, but it compounds. Over a 3 to 5 year horizon, these forces matter enormously, and they have already driven gold to levels that most analysts would have called impossible 5 years ago. The near-term tactical picture is the opposite. Real yields elevated, Fed not cutting, technical structure pointing lower, no visible catalyst to reverse the descending channel. These are not small headwinds. They are the primary variables moving price right now. The mistake is treating these two things as if they answer the same question. They don't. The structural case answers the question, is gold worth owning over time? The tactical picture answers the question, is this the right moment to buy? Those are completely different questions, and conflating them is expensive. So let me ask you directly, which game are you actually playing? Because the right answer to, should I buy gold right now, is completely different depending on whether your time horizon is 3 weeks or 3 years. Get clear on that before anything else. Rather than a directional call, what's more useful here is a map. 2 scenarios, each with a clear trigger. Scenario 1, real yields drop. This happens either because the Fed signals an earlier or deeper cut cycle, maybe inflation data surprises to the downside and Powell shifts his tone, or because a soft patch in economic data changes the market's expectations even before the Fed acts. If real yields come down meaningfully, The primary headwind for gold disappears, and the structural tailwinds reassert themselves. In that environment, gold doesn't just stabilize, it likely moves fast because the positioning has been bearish and short covering amplifies the initial move. Scenario 2. The technical structure breaks to the upside. Gold clears the descending channel ceiling at $4,450 to $4,470 on a closing basis with volume. That would signal the corrective phase is over, even before the macro picture formally improves. Markets don't always wait for the fundamentals to line up on paper. Sometimes positioning shifts and the chart leads. If you're already holding gold or miners, nothing in this analysis suggests the structural thesis is wrong. Hold through the noise. GDX and SIL will amplify the move when gold finds its footing. That's the nature of operating leverage in mining stocks. But don't add aggressively into a descending channel. If you're looking to enter new positions, current levels don't offer favorable risk-reward. There is still a live risk of another leg lower toward $4,200. Better entries will appear. The discipline is waiting for a defined trigger, either the channel break or a meaningful shift in real yields, rather than buying because the long-term story is compelling. The long-term story was compelling at $5,000 too, and that didn't protect anyone from the correction. Watch the 10-year real yield. Watch Fed language, specifically any softening around the inflation risk language Powell used at the March meeting. And watch whether support at $4,365 to $4,380 holds on the next serious test. Gold has already shown what it can do. The move from multi-year averages to $5,400 wasn't a mistake or a bubble. It was a rational response to real forces. This correction is also a rational response to real forces. The market is not broken. It is pricing what it knows. The investor who understands why gold is falling right now, not just that it's falling, but the yield math, the Fed's calculus, the inflationary mechanics of the conflict, that investor understands the market better than the one who is only watching the price and wondering what went wrong. Clarity on the mechanism is worth more than any short-term prediction. This video is for educational purposes only and does not constitute financial advice. The analysis here reflects publicly available information and my own interpretation of it, nothing more. Any decision you make with your own money is yours to make and yours to own.